Live from the Milken Institute's Global Investor Symposium in Hong Kong. This is Insight with me, Haslinda Amin. U.S. stock index futures climb in Asia on signs the next round of U.S. tariffs may be more measured than previously suggested. But China and Australia issuing fresh warnings about global shocks from the Trump trade war. Now here at the Milken Symposium, we'll be joined by PIMCO's Managing Director, President and Head of Global Credit Research, Christian Stracke, to discuss opportunities in bonds and private credit. Plus, we talk about the business of sport in Asia with Eldridge Industries co-founder, chairman and CEO Todd Boehly. Well, it seems like a happy Monday. We're seeing some relief among investors on signs that the next round of Trump tariffs could be more targeted than previously suggested. Bloomberg's heard from official sources that the April second wave of levies could see some countries, all blocs, being excluded. And the Trump administration is also said to be holding off for now on separate sector-specific tariffs that were set to be announced at the same time. Now, meanwhile, Chinese Premier Li Qiang told global business leaders gathered in Beijing that the country is prepared for trade shocks.
We may have unexpected shocks mainly from external factors. When necessary, the Chinese government will introduce new incremental policies to ensure the smooth operation of the Chinese economy.
Premier Li there speaking at the start of the China Development Forum in Beijing. Now, guests include top executives from across the world, such as Apple CEO Tim Cook. We've been asking delegates for their takes on U.S.-China trade tensions. Take a listen.
The tariff impact to us in 2018 was about $10 million. So it's a very small impact on a very large company. We'll continue to watch it carefully. We'll continue, but we're not going to react fast. We're going to watch what happens, and we're just going to make sure we continue to support our customers.
We're constantly looking how to become even more resilient, and I think this regional approach is actually benefiting us. So to supply 75% of what we sell in Europe, and to supply 80% in Asia, for Asia is very good, and now we're building up also capabilities in Americas, and that we have been doing for the last decade.
Our Chief North Asia correspondent, Stephen Angle, is at the China Development Forum in Beijing. Steve, give us a sense of the sentiment on the ground.
Well, the sentiment on the ground is caution, obviously, given the uncertainty about the next round of Trump tariffs and the impact on the Chinese economy. Clearly, Donald Trump's administration has well telegraphed the intent to apply more tariffs, already 20% additional because of the fentanyl issue. We don't know how far that might go if the Chinese administration does not resolve or address the fentanyl issue to Donald Trump's liking. And that is kind of a topic that is talked about a lot in the sidelines of the China Development Forum. In fact, when Li Qiang talked yesterday, he did not even obviously mention fentanyl. When China had its state media readouts of the meeting between Steve Daines, the Montana senator, and Li Qiang in the Great Hall of the People, where Steve Daines essentially said the main issue on these tariffs is fentanyl, and there is no room necessarily for further negotiations on non-fentanyl issues with the Chinese until the Chinese address the fentanyl precursor export issue that the White House claims is the main reason for the drug problem in the United States. But look, state media is not even saying or reading out that there was a discussion about fentanyl. So we're at loggerheads. So again, I think the fentanyl issue, according to the Americans, is far more important than how the Chinese are addressing it. They are looking after their own house, their own domestic economy, and trying to attract foreign direct investment, which fell by the most last year since 1990.
Of course, Steve, the tariffs escalating the tension between the U.S. and China. We know that the U.S. Senator Steve Daines was in Beijing. What was the messaging like?
Well, yes. I mean, Steve Daines, I talked to him right here on this spot about 24 hours ago. He said he had to wait to give us this interview until he had a chance to talk to Li Chang, which he did in the Great Hall of the People. And the big takeaway from that was, as I interviewed him along with my colleague from Bloomberg News, Lucille Liu, just as he was about to fly to back to Washington or back to the United States, he essentially said there is no other negotiations with China until the fentanyl issue is resolved. So a pretty succinct conclusion to those talks with the Chinese. But, you know, one offshoot of that is, how is this fentanyl issue going to be resolved? Well, one of the big reasons, or one of the big ways, would be a high-profile U.S.-China summit between Xi Jinping and Donald Trump. Only then can those two leaders give their various and their respective bureaucracies the marching orders to combat the problems that are souring relations.
Steve, thank you so much for that. Bloomberg's Chief North Asia correspondent Stephen Angle in Beijing. Let's get insights, perspective. We're live, of course, from the Milken Institute Global Investor Symposium in Hong Kong. Joining us right now, Christian Stracke, Global Head of Credit Research at PIMCO, which manages about $2 trillion in assets. Christian, good to have you with us. There's so much angst in the market. We're seeing some stability today, but, you know, some are saying perhaps we might see the kind of collapse which we saw during the dot-com bubble. I am aware you're not looking at the equity markets, but in terms of the general sentiment among investors, how would you categorize that?
Well, thanks, Haslinda. It's great to be here. Certainly there is a lot of angst out there. Certainly there is a lot of fear, and there's uncertainty around the path of policy in the U.S. That's really the story. But what we've seen a few times already is that we get statements that are fairly extreme and the results end up being less so. And I think if we see that pattern continuing to emerge of maybe a negotiating stance that is fairly alarmist, but a reality that is more manageable, then that angst should fade, and any fears of this kind of a collapse or a dot-com bubble or something like that should also fade. Conditions are very different today versus where they were in 1999. Yes, valuations are stretched. There's no question that they are stretched, and they are exposed to changes in sentiment, changes in economic conditions, changes in bottoms-up reality. But the companies that are highly valued today are much healthier, much more profitable than what we saw in 1999. It is night and day different in that sense.
Valuations are stretched even after the recent sell-off, S&P trading at 20 times earnings. The question really is whether the U.S. economy is robust enough to support the valuations and the kind of growth story that everybody's talking about.
Well, the U.S. economy is pretty resilient. I mean, we've seen this over and over again, that it keeps getting
So not concerned that the Fed has cut its growth projections for the U.S. economy?
Well, there's no question that growth in 2025 will be a little bit lower than what we and most were thinking, you know, as early as a few months ago. What we're seeing in the combination of policy, the tariffs will be a dampener on sentiment, and that will, all else equal, pull growth down. And also some of the fiscal tightening that we're seeing from the government efficiency initiatives that are coming out that will cut fiscal spending, and that will, all else equal, pull growth down. So that'll cool growth, but not anywhere near to the extent, in our view, that you get a full-on recession that would validate some of the fears in the equity market and in risk markets.
You're obviously in the right space. There's been a credit frenzy. Do you expect that to continue?
Well, I'm not sure it would be a frenzy, but certainly, like in valuations in equity markets, you're seeing that spreads have been very low. Now, they've been very low for a reason. Defaults have been low. Generally, corporate fundamentals are pretty strong, especially in the investment grade market. So you have spreads where they are for a reason. And no, we don't expect that there would be any, similarly to equities, we don't expect that there should be any serious pullback in credit markets anytime soon. But again, like in equities, valuations are stretched, and if there's economic cooling, if there's a cooling in risk sentiment, we'll see further widening in spreads. We are, if you look at our portfolios, we're a little cautious on corporate risk right now across the capital structure. But we're seeing a lot of opportunities away from corporate credit in asset-based credit, whether it's in securitized liquid markets or in more private credit markets in a lot of the asset-based opportunities that we're seeing. There you get very interesting opportunities, high single-digit type of returns, but without the frenzy that you mentioned in corporate credit.
There's a sense of that perhaps in some spaces it is overcrowded. Spreads are really, really so tight and thin. What are the chances it could tilt over?
Well, you would really need a recession. That's what it would be. Because fundamentals are reasonable right now, and so and also demand for fixed income is strong, and that's the important thing. That demand for fixed income is strong because the all-in level of yields is quite high. So people see that they're underinvested in fixed income, and they look for fixed income opportunities. That brings them into investment-grade corporate bond market. That brings them into the high-yield bond market. And those flows have been what have been supporting those low spreads in combination with relatively strong underlying fundamentals. So as long as that remains the case, which seems to be the case, the Fed is going to be cutting maybe 50 basis points or so this year, which leaves the all-in level of yield still quite robust. You'll still have those flows into fixed income. That'll still support the corporate bond market. You would need a much more serious turn in economic conditions to drive spreads significantly higher.
Is it then fair to say that the best opportunities right now would be in the U.S. and Europe? Given the turnaround in Europe, that's greater interest, and the U.S. seems resilient, as you said.
The best opportunities right now are in core duration in the U.S., the U.K., and Australia. By duration, we mean core interest rates, core government bond yields in the U.S., U.K., and Australia, where yields have repriced to an extraordinary degree. I mean, it wasn't that long ago, in 2019, that real interest rates were, so all-in yields minus expected inflation, were deeply negative across most of the developed market. Now you have a significant repricing into positive territory. If you had asked most clients 5 years ago, 6 years ago, when real interest rates were negative in the United States, and said, imagine a 2% real interest rate on U.S. tips, 10-year tips. A 2% real interest rate, how much of your portfolio would you put into that? They would have said, well, all of it, or maybe not all of it, but, a significantly greater degree of it. But that'll never happen. Well, here we are. Here we are with these yields that are extremely attractive. Now, people are not all in because we've had 3 years of an adjustment in fixed income markets, 3 years of volatility and 3 years of fear in fixed income markets. But as it becomes apparent that inflation is cooling and will continue to cool, and the Fed is cutting rates and will continue to cut rates slowly, then that'll keep that interest alive in fixed income, and then people will take advantage of these really interesting opportunities in those core government bond yields. And also the interesting spread opportunities in securitized credit, which remains interesting, not as tight to any degree the way that you see in corporate bonds, and also in what's being called asset-based finance, the private credit opportunities linked to residential mortgages, consumer loans, auto loans, equipment finance, that type of thing.
Before I touch on private credit, I want to touch on the high yielders. And Asia, of course, is home to a lot of the high yielders. Yeah. You get perhaps double the yield in the U.S. Would you find, the high yields in Asia attractive? Where would that be, and what would you be playing?
Sure, in emerging local markets, generally speaking, we do find those attractive. So those would be the local fixed income markets of some Asian and emerging in general. They sort of come and go in terms of which ones are most attractive, but what we would say is a diversified portfolio across EM local does look interesting. EM local, many emerging market central banks were more aggressive than the Fed and the ECB in jacking up rates to fight inflation, and so they have more room to cut. Inflation has been more responsive to come down in many of these markets, and they're following. So generally speaking, yes, we do like EM local, including some of the Asian opportunities.
Let's pick up on private credit.
Yeah.
Everybody is in on it. You have Blackstone, you have Polo, you have your pension funds, sovereign wealth funds. It does seem like it is an overcrowded market.
Well, let's step back a little bit and recognize that private credit offers a very interesting alternative risk premium, if we can call it that, which is the illiquidity risk premium. So how much do you charge for locking up your money for a period of time? How much additional spread do you get for that? And so that's what pension funds and many sophisticated clients have seen, is that if you want to find a diversifying risk premium that is not the same thing as an equity risk premium or a credit spread risk premium, then what could those be? And the illiquidity risk premium is that. So you lock up your funds and you get a return on that. So that's the opportunity. Now, what's happened is that it has been dominated by flows into corporate direct lending, basically lending to levered, private equity-owned companies. And that's a fine business, and that's a good business, and there's a lot of opportunities in there, but that's what's become crowded. And this year, the deal making has been less than expected, which has meant that if you have money to lend, there's that much more of competition for deals. And so you're seeing spreads come down. But spreads, even in direct lending markets, are still well north of what you see in the liquid leveraged loan market, the liquid high-yield bond market. You're getting less of a illiquidity pickup than you had in the past, but you're still getting a reasonable pickup in our view. But meanwhile, what's happening is that the opportunity is morphing into a much more diversified opportunity set. So especially since the regional bank failures in 2023, you're seeing U.S. and European banks looking for partners to take down a lot of the assets that they originate.
What is interesting right now is a convergence of private and public credit. I mean, are your clients now looking for a strategy that deals with both?
It's a great question. We have many requests right now from clients, sophisticated clients, that have exposures in public markets, have exposures in private markets, but are looking for something that straddles the two, looking for something where the manager, like a PIMCO, is looking for the best risk reward across public and private markets. They're really interested in the more investment grade profile of some of these private asset-based finance opportunities. So residential mortgages backed by the home, auto loans backed by the car, aviation finance backed by the plane. In all of these cases, you have collateralized lending. It is a more resilient opportunity. It's not double-digit returns, or maybe it's low double-digit returns, but it...
Before we let you go,
yeah,
we just want to know the biggest risk for markets in 2025 would be?
Hands down, let's not overthink it, it's inflation. Inflation is cooling, that's the good news. The most recent numbers have been constructive. But let's not forget the risk over the last couple of years remains the risk this year that inflation surprises
So the Fed might hike instead of cut?
No, it's unlikely, but that is the risk.
Christian, good to have you with us.
Thank you,
Christian
Haslinda.
Stracke of PIMCO. And we have breaking news right now. We have Philippine stock market to start trading after nearly a 2-hour delay. That is just coming through right now. Let's do a check on how the Philippines is doing at this point in time. We're also having the Philippines currently, PCOM currently down about 0.5% as trading resumes. And Indonesia's stock benchmark, the JCI, extending its loss. Remember, there's been trepidation in that particular market, murmurs of a possibility that the finance minister may be making an exit. She's come out to say that is not happening, though. That's not providing any comfort at all. The JCI currently extending its loss down about 3.6% as we speak. Quite a tumble there for the JCI. Well, keep it here with us. Our next guest co-owns the LA Lakers and is chairman of the Chelsea Football Club. Is now eyeing similar investment opportunities in Japan. Eldridge Industries Chief Todd Boehly will be joining us in just a couple of minutes for insights on the company's outlook and expansion plans in Asia. Keep it here with us. This is Bloomberg. Welcome back. Australia's treasurer is warning that the Trump administration's policies will have a seismic impact on the global economy. Jim Chalmers spoke to Bloomberg ahead of delivering his pre-election budget on Tuesday about the risks Australia is facing.
this is a whole new world of uncertainty that we're dealing with here. The changes out of the US, for example, are not surprising, but they are seismic. We're seeing uncertainty, policy uncertainty out of the US. China is slowing. We've spoken about that on a number of occasions. We've got conflicts in the Middle East and Europe. We've got political uncertainty and division around the world. And so the budget is designed not just to respond to all of that uncertainty, but to make ourselves more resilient in the face of those external shocks. And the Future Made in Australia is really the most important way that we're going about that. And there's billions of dollars in new investments in green metals as part of that effort.
Unannounced ones, or just the ones you've announced?
The ones that we've made clear already. They'll be budgeted for on Tuesday night. I mean, we've got a huge agenda that brings together our industrial possibilities, the energy transformation, the strengths and advantages that we have in critical minerals and in other areas. And so we intend to play that winning hand. The world is changing all around us. The world is fragmenting. Supply chains are being reconsidered and rebuilt. And we think we've got a very compelling offer to the world. And so the budget is about making the most of that opportunity, maximising our advantages in the interests of Middle Australia.
Now, on that, I mean, about a week after you hand down this budget, in fact, almost exactly, we're going to see new tariffs unveiled by the US administration on April 2nd. Are you worried that those tariffs could throw all your hard work in the budget completely off track if they are particularly, big or impressive?
Well, obviously, we're concerned about these escalating trade tensions around the world. As I said before, they are casting a shadow, not just over the budget, but over the global economy more broadly. Australia's got a very trade-exposed economy, and we are concerned about these trade tensions. Nobody wins from a trade war, least of all a country like ours. And so we're obviously engaged with the US administration, with our counterparts there, but we're also designing a budget which is all about making sure that we are beneficiaries, not victims of the way that the world is changing. Future Made in Australia is part of that. The Buy Australia plan is part of that as well. All of this is about recognising the way the world's changing and trying to make sure not that just we're not victims of that change, but that we can benefit from those change as countries around the world are looking for reliable partners like us.
Now, you've mentioned the sort of negative side from the US, but there's a potential positive side in that the new tariffs put on China might unleash a wave of economic stimulus from Beijing. I mean, obviously, there's a few unknowns at this point, but in your opinion, in the Treasury modelling, do you think that will end up being a net negative or a net positive to Australia when balancing those two factors?
Well, we've seen a number of steps taken by the administration in Beijing to try and support growth in the economy, but we're still seeing China slowing.
And that was Australian Treasurer Jim Chalmers speaking to Bloomberg's Ben Westcott in Canberra. Of course, we had breaking news right now. We are extending, Indonesia extending the losses on the JCI. Its benchmark currently below 6,000 for the first time since 2021, falling as much as 2.8%. In fact, it is down by more than 3% as we speak, dragged down by an extended slide in material shares on the back of plans for higher royalties. Of course, this is one market that's been under a lot of pressure on the back of the populist policies of the president, also murmuring initially about the potential exit of the finance minister. She has denied that is true. Again, the JCI currently down more than 3%. It is below, or it has since inched up above that 6,000 level. Coming up next, from the Milken Symposium in Hong Kong, we'll have Eldridge Industries Chief Todd Boehly joining us for an exclusive conversation on the company's outlook and expansion plans in Asia. Do keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Bloomberg's been told that Jack Ma-backed Ant Group has used Chinese-made semiconductors to develop techniques for training AI models that would cut costs by 20%. Let's bring in our China correspondent, Min Lo. Min, tell us about this breakthrough and what it means for the industry.
Yeah, it's quite an important milestone because Ant is claiming that it can train AI models using Chinese chips from the likes of Huawei and Alibaba at 20% less cost. And it's training these models that rely on the mixture of expert machine learning approach, MOE approach. It's deployed by DeepSeek and Google. It essentially breaks down a task into smaller data sets in order to enhance efficiency. And typically this approach would require high bandwidth memory chips that are, number one, very prohibitively costly, and number two, they are the most advanced of them are under export control. So Ant is saying that they are able to achieve the same results with Chinese chips as if you were to use an H800 chip from NVIDIA, and that's a scaled-back version of the NVIDIA chips that were designed specifically for the Chinese market in order to meet export control rules. And Ant is saying they're able to beat even Meta on some of these benchmarks, including English language understanding, but there are still some problems when it comes to certain parts of training, especially when it comes to stability. If you change just a small part of the AI model structure or the hardware, it leads to a big jump in error rate. So there are still some challenges, teething problems there, but a big important milestone that could slash development costs for the AI players in China.
Meanwhile, we're aware of the tensions within the US and China in the areas of tech and AI. I'm just wondering how this changes the calculus for that relationship.
Yeah, the rules of the games are very different in US and China because the paradigm is very different for the US. You look at Jensen Huang, what he said at the GTC conference last week. He said that the impact, the fears around the DeepSeek impact on US tech are unfounded because he said companies will still need more computational capacity. He's doubling down on creating bigger GPUs with more transistors, more processing cores, more memories. But China is kind of going the opposite way, where they're doubling down on getting using cheaper chips and lowering making the computational process more efficient. So very different way of moving ahead in this race.
Min, thank you so much for that. Bloomberg's China correspondent Min Lo. Now, S4 Capital Executive Chairman Martin Sorrell says he remains bullish on Chinese tech due to AI and the government's softening stance towards the sector. He spoke to us ahead of the China Development Forum in Beijing.
What DeepSeek indicates is the strength of the Chinese tech industry. Going back to President Xi meeting with the tech leaders, you know, when you I think I'm right in saying Alibaba was going to be split up into 5 pieces.
6 pieces, yeah.
6 pieces at one stage.
They scrapped that.
They haven't been done, right? Yeah. So that's interesting because I think that's also reinforces the point that we were discussing, that big tech is hugely important. And, you know, you should see it if you're in government, whatever the system is, you should see it as an enabler, not just for growth, but for security, defense, and other objectives. So I think that is happening. And I actually feel that, you know, I'm more bullish on the China. I've always been a raging bull on China. I will continue to be so. I'm a little bit more bullish now, maybe against the trend than before, because I think the Chinese government in the last year has tried to address the issues, has tried to take a more stimulative position. I don't know how much more firepower they've got. I think they have some. And I think my view is they should use it.
What does DeepSeek and the others do to the calculus for tech valuations?
Well, obviously it shifts the needle, but it increases the primary demand for AI. I mean, DeepSeek...
Open source does not necessarily make the kind of returns that OpenAI and others are trying to talk about. That's why they justify the investment.
The key is the utilization. If you're asking about the capex, you know, I got chastised. I remember we were having a private conversation with a group of people, and I said, you know, I was a bit concerned about the level because the Mag 7 spend $500 billion a year. You know. Amazon's at 100 billion. I think Microsoft is at 80, Google's at 75, Meta's at 60. I mean, these are huge amounts of money each year that are invested in capacity. Is it too much? And NVIDIA, who we have a close relationship with, said to us last year, the big issue is use cases, or lack of them. Mm-hmm. This year, it's the same thing. What you're seeing is, as a result of DeepSeek, and in fact, applications that will be even more effective and even more efficient, it's going to increase the primary demand and accelerate it. It will bring into question what you're saying, what you're asking about, which is, does it make sense to spend all that money on capacity? I mean, I won't go into the detail, but there was a famous story that I was told of one government seeking to invest heavily in data centers. And when the authorities were asked, why do you want this capacity? What are you going to do with it? They said, don't worry about that, we'll figure it out. And I think that's what's happening, that everybody sees this as a prize. They want to build the capacity, but the use cases are not there.
And that was S4 Capital Executive Chairman Martin Sorrell speaking with our Chief North Asia correspondent, Stephen Angle, in Beijing. Now, China's AI boom is forcing investors to focus their attention on markets and opportunities outside the U.S., especially here in Asia. We're coming to you live from the Milken Institute Global Investor Symposium in Hong Kong. Joining us now is Todd Boehly, co-founder, chairman and CEO at Eldridge Industries. He's also the chairman and owner of Chelsea Football Club and an owner of the LA Dodgers, the LA Lakers, the LA Sparks, and Cloud9. Prior to founding Eldridge Industries, Todd was president of Guggenheim Partners and founded the credit business at Guggenheim. We can talk about everything under the sun, given what you've done so far. First off, let's talk about the economy. There's so much concern about how the U.S. is sneezing and the rest of the world will be catching a cold. Do you see that when it comes to the investment climate?
Listen, I think we look at it over long periods of time. I think the U.S. is retrenching, and I think healthy retrenchment is really what allows you to move on to the next plateau. So I think the good news is that there's been, things got a little bit ahead of themselves, and now we've retrenched, and I think we're going to watch what I hope and expect. The whole world's waking up. What Germany's doing, is really interesting. I think what's going on in the Middle East is very interesting. And I think America is just a locomotive engine that will end up, continuing to be very strong. Whether or not it goes in a direct line, I don't think so. But long term, I think kind of this mark-to-market that's going on in our country, I think is really healthy.
But is environment influencing, shaping where you put your money, where you're investing?
Most of the things that we do are thinking about it as measured over long periods of time. So we try to find trends, and we like to be in businesses that are good businesses day in and day out. Right, senior secured lending, I think, is a good business day in and day out. So there's not volatility when you're at the top of the capital structure. And so much of our activity is at the top of the capital structure. So it really doesn't influence whether we're in or out or in or out. Frankly, it would be really hard to kind of build long-term businesses with the idea that, a daily update could change how your philosophy evolves.
You've talked about how you want to be in all things credit, but private credit in particular is one very interesting space. How are you looking at that?
I think asset finance is a very big one. I think we're starting to see the evolution of more sophisticated ways to finance all types of assets. So to be able to bring to the table an asset finance team, a private credit team, a structured credit team, a real estate credit team, so we're all things credit, really in support of 6,000 private equity firms out there. That's one of the themes that we're really going to be hammering on for the next decade.
But in terms of private credit, some are saying that you're beginning to see some cracks because there's it's an overcrowded space. Your pension funds, your sovereign funds, they're all in it and in it big. Do you see those cracks coming through?
I think pricing has evolved a little bit. I think covenants are remaining in place. But really, when someone talks about cracking, ultimately, if this cracks, it means the economy had cracked, right? Or an industry cracked. So I think as long as the economy is decent and as long as the industries are continuing to grow, right, then I feel like the cracks are more to be talked about. If you look at corporate credit defaults over long periods of time, and whether that forms in private credit or broadly syndicated or investment grade credit, whatever the credit is, the cracks usually occur because there's a major downturn or because an industry got sick. So if those two things don't happen, now ruling out like fraud and things that are go wrong because of things that are nefarious, but generally an industry gets sick or the whole economy gets sick. And we don't see any of that happening at this time period. Obviously, because the market's gotten so big, there's more and more commentary on it. But the reality is the broadly syndicated loan market is a private credit market, right? So private credit, the definition of which is evolving as more and more people want to get access to what's a growing market. But I think if you look at Tokyo, you look at Hong Kong, you look at China, private credit's in the early days. So I think there's opportunity all around, but you have to get governance set up so that you can export private credit opportunities. But the reality is, the reason America, in my opinion, is so creative and so innovative, and it's because the depth of the capital markets. People can get financing for just about anything.
I want to talk about Japan. You touched on it. I mean, it is bucking the M&A trends because companies have to get rid of their non-core assets, for instance, and lots of activity going on there. How are you looking at the Japanese market?
Well, I think the Japanese are waking up to the idea that, there's a lot of other markets inside their market that need to be built. So I think the leveraged credit markets, I think the LBO opportunities, I think when you look at the vast number of companies in the Tokyo Stock Exchange are worth less than $2 billion, right? So one of the challenges that they have is companies go public and they really are too big to be followed, so they kind of sit there as an orphan. That's a perfect opportunity for the LBO business to start to build up. So I think the LBO business is one that is exciting to think about for the next decade in Tokyo. And I also think the carve-outs that you're talking about are another big opportunity. So when you think about when is private equity really good for kind of solving things, it's carve-outs of non-core assets, as well as taking forgotten companies private in a marketplace where no one cares.
Todd, I'd like to pivot
Please.
To Chelsea Football Club. There's been a lot of tension between the owners. There's an ownership struggle. Is there a sense, are you any closer to deciding whether or not you'll...
No, I think what the media writes about and talks about is exciting, right? But I just don't think it's realistic. I mean, I think if you look at the evolution of the team, we've been aligned on what we're trying to do and what we're trying to build. It's a team that's young. It's a team that's got long contracts. And all these things were new. And of course, in order to do all those things that we've done, it's obviously because we're aligned. So I think if you look at what's actually happening, and don't follow kind of the shiny light, right, then you'll see that there's core stability. There's been a long-time theme. And I think we're executing on a plan that ultimately will have Chelsea where it belongs. I mean, we're sitting top 4 in the table right now.
But it's not at the top of the table, and some say that perhaps it can do better. But in terms of ownership, I mean, where is that going? Are you any closer to deciding whether you'll sell your stake
I think the status quo is something that's just fine. I think we've learned from each other, and I think we're really going to be able to work it out any which way.
So, status quo for the next foreseeable future.
And I think we have to think about long-term, what we're trying to accomplish. We have a big stadium development opportunity that we have to flesh out. And I think that's going to be where we're either aligned or we ultimately decide to go different ways. But again, I think that what's been written and what's been talked about, is much more drama than what is actually happening.
Let's talk about that stadium development, because it was something that was top of your agenda coming in. Is that going through, or will you be moving premises?
No, I think
some clarity on
stadium
it.
development is going around the world. Right now we're going to see Africa build stadiums. Obviously here in Hong Kong, they're opening their new stadium for the very first time. So stadium development is definitely a theme. You're going to see the NBA go to Europe. You're going to see they need stadiums. They need arenas. Sporting infrastructure. I think we're just on the very front end of this sporting wave, and sporting infrastructure is going to be a big thing about it. We have 16, 20 years to figure out obviously inside of London, it's really complex, right? It's not as if we're building something in the middle of a rural environment. So we have a lot of constituencies to make sure that we care about. Certainly the Chelsea fan base is one, but long term, I think we're going to be building something new, and we'll figure it out.
Let's talk about that value. You paid $2.5 billion for Chelsea FC.
Yeah.
Is the club worth less now that it hasn't won any trophies, that it didn't qualify for the European Champions League, or is it worth more just because of, the league being so popular?
I think the trend is our friend, in this industry. I think the opportunity to be able to grow the fan base around the world, right? Because unlike American sports, we have the ability to grow internationally and build our own revenue base, on that international fan base. So I think the opportunity is enormous. I think the Premier League is, sitting in a great place. I mean, one of the frustrating things as Chelsea owner is that the Premier League's become so competitive. But one of the great things about being in the Premier League is it's gotten so competitive. So, the depth and the quality of the teams are unlike any other league in Europe. Or anywhere in the world. So I think the whole element of what's going on, because I don't think it's not really a derivative of did it win last year or did it win this year, right? I mean, this is a club that just celebrated its 120th anniversary. And
so it's more valuable than what you paid for?
Yeah, I would say yes.
Where do you go from here? Because I know that I think you and your group bought a cricket team recently.
Yes.
Would you be interested in buying a cricket team in India, for instance? The IPL is huge. There's a lot of potential.
Yeah.
Is it something you might consider?
We haven't studied it, but this is one of the things we always like to do is to make small investments to figure out the landscape around us. And the opportunity in England is a small investment in a cricket club that will give us a lot more knowledge, a lot more insight, and we'll follow our experience and we'll follow our knowledge base. But if you look at kind of our whole investment strategy, we started out as lenders, right? And when you're lending, we also called that we would date through the debt. We'd get to know a company, we'd get to know an industry, and as we got more and more comfortable, then we would expand further into the capital structure. So I think cricket's a perfect example of that. We love sport, we love what sport means, we love competition, and the opportunity in cricket in the UK we thought was a very unique opportunity. And whether that leads us to further development, I think having...
You're not saying no.
I'm not saying no, but I think I'm definitely not saying no. But I think Mark Walter and I have the potential to build probably the preeminent sports platform in the world, right? So that's one of the things that's continuously on our minds. And a global footprint for a top sports company in the world, right, sounds pretty interesting.
What do you make of valuations? Are these sports groups and teams getting way expensive? If you take a look at, I think it was Celtic that went for more than $6 billion, and that's possibly was the most expensive, purchase in North American history.
Yeah, I think if you look at what's going on in the NFL right now, right? The Eagles just traded for roughly $8.5 billion, I think, or $7.5 billion, something like that. So, a 10% non-controlling stake just traded at, north of that 6.1. That 6.1 reflects the fact that time shifts for any other media, right? But in the sports, you have to watch it live, so you're going to get a giant audience, and you're going to be able to talk to that audience in a very kind of direct way, right? If you're a media company, if you're an advertising company, so the fact is everything else is time shifting, and sports continues to get people's attention at that moment in time. That's extremely unique. So, right, I think when you think about the future of valuations, in the sporting industry, right, the whole NFL, right, it's probably worth $300 billion. Netflix trades at $400 billion right now. I'd rather own a share in the NFL at $300 billion than a share of Netflix at $400 billion. The fact is, when you own and control intellectual property like that, you're only limited by your creativity as to where it can go. So I think that the industry is going to continue to go up in value, but it's because there's more attention, more revenue coming in its direction. So it's not as if these valuations aren't making sense. They continue to make sense. And there's very few of them, right? But they're the beating heart around the industry. And then you have all these other industries developing around the beating heart. And the beating heart continues to go up in value. All the other ancillary activity is going to continue to go up in value.
What next for you? What are you eyeing? What would you like to buy? What would you like to expand?
I think we're really excited about a couple of our businesses right now. Metropolis, we're the largest parking lot operator in the U.S. We have over 2 million sites, 2 million parking spots, and we're integrating all this with technology and computer vision and large language models. And we just bought a facial recognition business. And I think one of the things we're seeing, right, is the fact if you want to be efficient with time, you have to trade your privacy, right? So ultimately, we went on that journey when we started with the smartphone. The smartphone really creates time. It creates the opportunity to be more efficient. And now, I think we're going to continue along that journey. But you're going to get to a point where you're going to be able to walk into a store, and they're going to have everything laid out for you. You're going to be able to try it on. You're going to be able to leave, right? So you're just all about saving time. Time is the denominator in all of these equations.
Todd, you've been successful in most of the things you've done. In fact, all of the things that you've done. I'm just wondering, if you could look back, what's the one mistake you've made that you wish you hadn't?
Anytime I try to do something that's not branded or a franchise, it seems to not work. So I'm really focused on intellectual property. I think as distribution costs have gone down for distribution networks, right? All that value that used to go to, when Fox started with sports, Fox had to pay hundreds of millions of dollars to put together their network. Right now, their network is really easy to access. They plug right in, and you can basically be anywhere all at once. So, that dollars that used to be allocated to the infrastructure is now allocated over to the intellectual property. So I continue to believe our investments in Amon, our investments in FlexJet, these are top brands in their industries, and the intellectual property is great.
Todd, it was great having you with us. We have to speak again. Todd Boehly, co-founder, chairman, and CEO at Eldridge Industries. Plenty more ahead. Keep it here with us. This is Bloomberg. Just moments away to noon, and this is how it's looking for the stock market here in Asia. Some stability in the market as we come down to the 2nd of April, where tariffs will be implemented further by the U.S. Of course, traders remain on edge due to warnings from officials in China and Australia. Investors bracing for more vol. Taking a look where we are in terms of the MSCI Asia Pac Index. It's now in the negative. It does seem like fear is returning to the market, currently down 0.3%. The JCI in particular, a big laggard today, dropping as much as 3%. Now, before we go, here's a look at tomorrow's guests joining us from the HSBC Global Investment Summit in Hong Kong. Keep it here with us. This is Bloomberg.